Well, anyway, thanks everyone for joining here on, a lovely Wednesday afternoon, and thank you, Tony, for putting this together. I hope it'll be valuable for you guys. We try and wherever we can, we try and find educational stuff that I think is valuable for you guys. And Tony has suggested this, and I want to make sure we brought it to our audience. And key thing is, if any folks in the audience think of things that you think would be valuable to you guys, please let me know. We're happy to bring the experts to the table, like Tony or any of the others. I know we're doing a seminar in January about pension stabilization funds, and we're looking for something for OPEB and pension obligation bonds in February. So any ideas you guys have you think would be valuable, certainly reach out. With that, I'm going to turn it over to Tony. I'll skip the long biographical introduction. I figure you guys, most of you know him already, and I don't want to waste your time. I will put his bio in the chat so you guys can read it if you're so inclined, but I figure you probably read it when you got the invite anyway. So I will do that, and at this point, I'll hand it over to Tony.
Thanks, Parker. Thank you for skipping that introduction. I think I've got in my bio, I think I have every letter in the alphabet at this point, and that's just the more letters you have, the older you are. So when people are reading that off, I kind of it kind of reminds me that we're getting close. So, but hey, thank you.
Started this stuff in grade school.
Yeah,
way back in grade school.
Thank you, everyone, for attending today. In my opinion, this is an incredibly important topic. And just to share you a quick story of why we're here, I was presenting for the Accounting Association back in September. I think it was September 22nd. And I guess Jim Powers had done an ARPA presentation on the 21st, the day before I did my presentation. And on that Tuesday morning, as I'm trying to get to the Cape, my phone's blowing up, my text is blowing up, my email's blowing up, and I'm like, gee, what's going on here? And it was just people asking about, revenue and ARPA, and you get this revenue thing that you can use. And I hadn't really given it much thought until that day, because most of the clients I had talked to said, hey, we didn't have a loss. We made money. We beat our forecast. We ended up with surplus. And so I hadn't really given it much thought. I said, well, nobody's really interested in doing this, so I'm not going to really go down that path. And that week, one of my clients actually sent me their calculation, and this little town with about a budget of $10 million ended up with $500,000 in revenue replacement, and that they could use basically for anything. And I'm like, well, how do they get to that? So I started going through the calculation. And it worked out. When we actually went through it, it worked out. They actually were getting this $500,000, which will make a huge difference to this small community that doesn't have an enterprise fund, that doesn't have wastewater, that doesn't have the infrastructure things that are talked about in ARPA. So I started really looking into this much more, and I've spent a lot of the last month really researching, spent some time with the Division of Local Services, Deb Wagner, getting her ideas on the topic, how to present these things on the tax recap, how does a DOR want to see it in the balance sheet that gets submitted, and basically kind of put together a presentation of all these discussions. So shout out to Jim if he's on, or someone from Powers and Sullivan, for getting the ball rolling here. And But I think this is a really unique opportunity for towns and town officials to make a difference with these funds. So I'm going to share my screen and we can go through a presentation, ask questions as we go. And I'm going to go through a real live calculation at the end. The Town Hall, Mike Buckley, is allowing me to use his calculation. So we're going to go through one at the end of how we kind of put it together and what goes into it. All right, revenue calculation under the American Rescue Plan Act, more commonly known to all of us as ARPA. So today what we're going to do is, I'm going to do a quick overview of ARPA, go through the interim final rule, do some real quick and dirty, just for those that are still a little fuzzy on it. I won't spend more than 5 minutes on it. Most of this discussion is revenue replacement. I've seen a lot of literature out there and a lot of presentations on ARPA itself, but I haven't seen anything really as in depth with what I'm going to do on revenue replacement. So I thought this was a really good opportunity to do this. And then basically talk about how to use revenue replacement as a strategy in your fiscal spending. Okay, I just want to get a quick poll question. Parker, if you want to roll it out. Just want to get a feel for the audience. I am very comfortable with ARPA guidelines. I'm somewhat comfortable with ARPA guidelines. I'm not comfortable with ARPA guidelines. And if you guys could quickly click on that survey, just want to kind of get an idea of you know, the level of knowledge that you folks have gained so far. So we'll give you a minute to fill that out, and then we'll go on to oops. Okay, ARPA overview. The bill was signed into law this year, March 11th, 2021, about a year after the CARES. Okay, so we've got, let's look at the results there. We've got, looks like most of you are somewhat comfortable. Very few are very comfortable. And we got about 28% that are not comfortable. So I think this is really an important, this is telling me that this is very important and a great idea. So thank you for participating in that. All right, so the bill was signed into law this year, about a year after the CARES bill, March 11th, 2021. 350 billion was allocated to what's called Coronavirus State and Local Recovery Fund. And this was the pocket of money that held up this big stimulus for months. It was being used as a pawn in the election. The Senate and the House were going back and forth on how much they wanted to give to state and local government, if any. They had provided CARES, but CARES was really an expenditure-driven grant when this wasn't an expenditure-driven disaster. This was a revenue-driven disaster. This wasn't like a hurricane or some sort of, you know, crazy storm, weather-related disaster. And there's only so much you could spend on the expenditure side, but the CARES did not allow you to replace revenue or do something with revenue. So this was designed to provide some of that to the state and local government. And it was a nice little idea, and it finally gained traction, you know, after the election was done and new president got into office. This finally gained traction, and like I said, got signed into law March 11th of 2021. Massachusetts got 8.7 billion. 5.3 went to the Commonwealth, and 3.4 billion went to the cities and towns. Unlike CARES, it's going directly to you folks. There's a piece that is going through the counties to you folks, and some of it is going directly to you folks, but it's not going through the state. So the interim reporting requirements are directly to the Treasury, and not which is the federal government, and not the Commonwealth. I know you've gone through this process with A&F of doing these reconciliations and reporting. That's not going to be required with the Commonwealth, but there's a similar reporting process required with the feds. Single audit is going to apply if you spend more than $750,000. You're going to need a single audit of your expenditures. And for the most part, almost all of my clients that didn't have single audit have gone into the single audit bucket, or are very, very, very close. So be aware of that you could be having a single audit, which means your documentation needs to be that much better. You need to have things ready to present to your auditor. I'm stuck here. Sorry, my screen's getting stuck. So the interim final rule is kind of the guidance we're using for ARPA, which was effective May 17th of this year. And it basically put the ARPA funds into 4 different buckets. You had the bucket that is basically a response to the public health emergency. and its economic impact. So that would be like plexiglass, mass, or outreach to local businesses that are affected, even households that are affected, social impacts, things like that. That's the first bucket. A lot of that was similar to the bucket that CARES had. The second bucket is premium pay to eligible workers. So workers that were going through the pandemic or are doing extra duties are eligible for premium pay. Those aren't getting used as much in ARPA, I would imagine. The next two are the big ones: revenue replacement, which we're going to talk about today, and then the easy one is infrastructure. A lot of my clients are saying, hey, we got a sewer treatment facility we got to do, or we got some wastewater project, or we're putting in some big water treatment project, or some of the towns out west are designing their cable. So so buckets 3 or 4 is where I think we're going to see a lot of the expenses, and our focus today is going to be on, like I said, the revenue replacement. Your eligible expenditures must be obligated by December 31st of 2024. They must be paid by December 31st of 26. You should have gotten half of your grant by now. If you haven't, it's because they don't have the wiring information. So you probably want to get a hold of someone if you don't have it by now, but you should have half of it by now. And the second half you're going to get next summer. I'm thinking May or June, I'm hearing, for the second piece of the grant. So a lot of communities, in fact, most of the ones I talk to, are earmarking significant funds to eligible infrastructure costs. So that's easy. It's easy for them. Those that don't have enterprise funds are going to have a problem spending the funds because you don't have the type of infrastructure that this is earmarked for. So for those towns, it becomes very important for revenue replacement. And even for the towns that are earmarking it for eligible infrastructure costs, I would advise you just go through the calculation. That way you have flexibility in case you decide not to use it on the infrastructure costs. Or, for example, if you've got some emergency disaster like 2015 with all the snow and ice and everything else, you can kind of tap into this fund to take care of some of that stuff. So even if you say, hey, we're doing all infrastructure, I would still advise you to go through the calculation just to know that you have this piece of revenue on the side that can be used for basically anything. Okay, so poll question 2. Community, have you earmarked yours for eligible infrastructure, or are you seeking other ways? Parker, do you have that poll question? Next one, Parker.
Sorry about that. I get to the next poll. My bad. All right.
Got to keep Parker on his toes here.
Second poll. My bad.
Let's give that a few seconds.
Hey, Tony, while they're voting, Kelly had a question about saying they will not be able to use it for roads as it was first mentioned.
What was the question?
Her question was, so it won't be able to be used for roads as it was first mentioned?
Yeah, if it's not revenue replacement, you cannot use it for roads unless the roads are part of some sort of water or wastewater infrastructure project. In other words, if you have to rip the roads up to do your wastewater or water infrastructure, then those roads would be eligible. But if it's not revenue replacement, no, you can't just earmark it towards road work.
Okay. And we have another question.
Tony, I was gonna say, I think that actually answered Alicia's question too, about paving of the roads.
Okay.
If it relates to water and sewer.
We also had a question about when will the county allocations come to the towns?
The first half I'm seeing is already out there. So you may want to get a hold of your county. Maybe it's going by county, but the towns I visited, the first half of the county allocation is I'm seeing it out there. So check with your county. Should be getting it. It might be by county. Some of the counties might be behind. The one I looked at yesterday, they got their county allocation at the end of August. The one I looked at yesterday, and I think that was Middlesex County. So, so you may want to check with your county. So to look at the poll question, about 40% have used it for eligible infrastructure or have earmarked it for eligible infrastructure, and about 60% are looking for other ways to use it. So this is, again, this is very, very applicable and relevant, this topic. So happy to continue and help you folks out. Okay, I just wanted to throw down some useful links. Here are the resources that I use to put the next section of the PowerPoint together, which is the revenue replacement calculation. The interim final rule, so you got a link there for that. There's a Q&A, which is great. That came out in the middle of July. It's about 20 pages, and it's really got, it answers a lot of the questions that you probably have relative to ARPA. Bureau of Census is here because that's how they're telling us to look at revenue and what you include in this revenue replacement when you're comparing periods, which revenues to include and which ones not to. So the Bureau of Census is a pretty important document. And then the Census of Governments is important when you're looking to see if related governments can take part in your revenue loss and your ARPA, such like, you know, redevelopment authorities, regional school districts, things like that. That's kind of important to address that. So I put some of the links I looked through to get to this point. Okay, the calculation. So this is right out of the legislation, or actually out of the interim final rule. Bucket 3, which is revenue replacement. It's for the provision of government services to the extent of the reduction in revenue due to COVID-19. It compares your most recent full fiscal year to, and they're doing all this on a calendar year going forward. So your most recent full fiscal year is going to be getting compared to calendar years. The first of which is 12/30/20. So that's in the interim rule. This is what allows us to do what we're going to do. Revenue replacement. Okay, and here's where it's very important. It gives you flexibility. You can use this basically for anything except debt service, pension, legal settlements, and transfers to stabilization and other types of reserve accounts. So you can basically use this for anything. It's just a very valuable chip to have if you're having trouble balancing your budget, and there's some one-time type items in your budget. That's a great way to use it. Some towns are actually using it in their budget, which I don't advise that if you're using it for salaries and things like that, because then you do tend to create a structural deficit. But you can basically use it for whatever you want. And I'm going to show you how those mechanisms work as we go. So basically, the way the calculation works, it applies a growth rate to the base revenue amount. So you come up with your base revenue and you take the growth rate. The growth rate that the feds came up with is 4.1%. And they did this through a national average of growth in like 15,000 communities throughout the country. And they came up with the fact that for the immediate 3 years prior to the pandemic, those communities were growing at a rate of about 4.1%. So they're allowing you to take that rate and apply it going forward using 19 as your base. So you take 2019 base revenues, you use 4.1. What's great about the first year, which is fiscal 20, because the year ends December 31st of 2020, you're able to use not only 4.1%, you're able to use half of the prior period that ended right after June 30 of 19. So you've got 18 months. So they're actually going to let you use, it's 6.21%. And this is what's allowing a lot of the towns that I'm looking at to end up in a revenue replacement situation. If you think about it, your property taxes are growing at 2.5% plus maybe 1% for new growth. So they're growing at 3.5%. Your state aid was flat last year. the Commonwealth flatlined your, they level funded your state aid. So most governments did not, and those are usually, normally your two largest revenue sources. So most governments didn't grow at 6.5% when you look at everything. So you're kicking in these one-time nice little funds that you can use. So once the growth rate is applied, like I said, you come up with an amount that you can get to called counterfactual revenue. So say your base is 100 million, and in the first year it's 6.2%. You can actually make up to 106.2. Anything under that is considered a revenue loss. Even though you did better than the prior year, if you're under the 106.2, is considered a revenue loss, and that becomes the funds you can use. Yeah, any deficiency, like I said, in actual revenue becomes the part you can carve out. Okay. Now, how is revenue defined? There's tons of revenue. You got revenue in your capital projects, in your special revenue. You got general fund revenue. You got revenue in your trust funds. So how do they define what revenue do you actually use? And the interim final rule basically says the general revenue that is based on, but not identical to, the Census Bureau's concept of general revenue from owned sources. And you remember a few slides ago, I gave you the link for the Census Bureau. In there, it defines which revenues are what, which you would use as general revenues. So basically, you're including revenue from taxes, current charges and fees. Those are permits, licenses, miscellaneous general revenue. It excludes refunds, correcting transactions, proceeds of debt are excluded, sales of investments are excluded, agency and private trust transactions are excluded, utilities are excluded, insurance trusts like self-insurance funds, those are excluded. So, so a whole bunch of things, and we'll get into exactly what they are when I go through the calculation. If the revenue is ambiguous, you come up with something that you think is ambiguous. This is where you go. You go to the census. So pretty much property taxes, black and white. But if you got something that's ambiguous, and one that keeps coming up is MSBA, and I don't have an answer to this yet, but MSBA could cause this to swing big time if you're in the middle of a school project. So you could have a $20 million receipt from the state in 2019, but not have anything in calendar year 2020. And guess what? The calculation may include that as a revenue loss. So I don't have a concrete answer to that yet, but based on what I'm reading, that seems to be the direction where this is going. So, so we are trying to get some visibility on that. The other ones we've pretty much got nailed down between the CPA groups and the Division of Local Services. We got the other ones pretty much nailed down as to what's included and what's excluded.
Hey, Tony, if I could interrupt for a second, a couple of timely questions. One person was asking, be clear about the start date for calculation. Is it January 1st of 2018? I thought you indicated starting FY19, looking back 18 months.
Yes. So, so the base year is July 1st of 18 to June 30 of 19. That's the base year. The 18 months that I'm referring to is the December 3rd, the first calendar year is December 30 of 2020. December 30th of 2020 goes from January 1st to December 31st. So you're missing 6 months. You're missing from July 1st of 19 to December 31st of 19. The feds are saying, take the growth rate and you're going to apply another 50% to your growth rate because of that missing 6 months. That's where the 18 months is coming from. But the first year is clearly July 1st of 18 to June 30 of 19. The calendar year, first year, is January 1st of 20 to December 31st of 20. So hopefully that clears up that question.
Okay. Another one that was kind of in line with your MSBA, but it's different. Angel Wells wrote in and said, our community had brand new general fund revenue from cannabis excise in calendar year 20. If I include this new revenue in my calculation, it falsely appears that we did not have a revenue reduction when in fact meals, hotels, and motor vehicle all decreased.
Yes, so unfortunately, that's one of the one of the problems with those that had cannabis. I'm finding that the ones that are not qualifying or not eligible for revenue replacements are the ones that started up a cannabis situation in calendar 20. I had one community that received close to $1 million, and it really screwed up their revenue calculation because it was zero in 2019. So even though it's new revenue, you still have to include it in the calculation. And unfortunately, it's gonna end up probably disqualifying you. I've only seen one of those situations so far, but I understand there's probably a few around the state that are going to be in that situation. The other times that I'm seeing that it's going to get squashed is when you have a significant debt exclusion. So if your real estate taxes, if you've undergone some big time debt and you're paying for it through a debt exclusion, it's bumping up the 2020 taxes enough so that you're exceeding the 6.5. I had one community that the debt exclusion was close to 10%. It was just a major amount, and it disqualified the calculation also. But for the most part, most communities I'm looking at, about 70% are getting something out of the revenue replacement. So hopefully that. Any other questions there, Chad?
Sandy Pooler wrote in, and just to follow up on your debt exclusion, he does say it seems to count against them, but he wrote to the Treasury and has not heard back yet.
Okay, and that's I think Renee from Powers and Sullivan did say that some of her communities are writing to the Treasury. So I'd be excited to know, what the Treasury has come up with. I don't know when, Sandy, when you sent that email. It was probably over a month ago or close to a month ago, I would imagine, because in the conversation I had with Renee, some of her communities were doing that and trying to get an answer to the debt exclusion and if there could be an exemption on that in calculating the revenue replacement. And also on the MSBA, there's been emails going out to the Treasury on the MSBA. Unfortunately, right now, all we have to go on is the interim final rule, the question and answers, and the U.S. Bureau of Census. That's all we have to go on right now, other than emails we get back from the Treasury, and they have yet to answer some of these important, very important revenue changing calculations, and so hopefully we get a little bit more transparency on that, as we move forward. Okay. Any other questions, Chad?
Yeah. So there was a question to clarify, and this probably is a big swing. Old MSBA versus new MSBA.
And this is my opinion, old MSBA is good. Because it's really based on debt. It's not a construction reimbursement, because you've got to factor in your interest and your debt service, and that's how that was calculated back in 2003 and 4 when the state did their big project. So to me, that's more of a reimbursement for debt. I'm inclined to include that. It's typically the same from year to year, unless 19 was your last year. I do have a client where 19 was the last year, so they'll get a little bit of a benefit there. But in my opinion, that's okay. That's a grant based on how your debt service is being paid down, and not so much your construction. The MSBA that's going on now is a direct payment for construction. So that's a little different in my opinion, but we may end up having to include them both depending on what the Treasury comes up with. That's still up in the air.
Another one was, would motor vehicle taxes be included?
Motor vehicle excise, yes.
And someone had a question, Sharon. We had a $4.25 million override in FY19, so our growth rate in the year prior to the pandemic is higher than usual. Do I need to do anything, or is this just to our benefit in the revenue loss calculation?
Yeah, so what I haven't had to do yet, but what they allow you to do is if your growth rate is higher and you can prove it, you got to go back 3 fiscal years. So you got to go to 16, 17, 18, and 19 and calculate your growth rate from 16. So basically you're going to take your revenues, line them all up, the ones that are includable and excludable, and figure out what your growth rate. I have one client that that I did a quick and dirty calculation because they were not going to do the revenue replacement. They ended up with a 9.2% growth rate, which was significant. And these are towns down the Cape, tremendous growth down the Cape. So I'm seeing that. So if you're down the Cape, you should go back and look at your growth rates because you could actually beat the 4.1%. This particular one was 9.2, like I said. And when you factor in the extra half, the 1.5, now you're at 14%. So you're basically going to qualify. It's such a big number. It'd be difficult to not qualify under that situation.
Right. Couple of things for clarifications, and I think maybe it's worth clarifying that the revenue is not just general fund, correct? Because someone was asking about gifts and grants, or is it just general fund?
Yes,
revenue?
as I get into the presentation, you'll definitely see that it's not just general fund. I've gone to clients that have given me their calculation and it's just general fund. And I'm like, no, it's not general fund. It's all funds. It's all funds. And then we're going to exclude some. So when we get to so for example, we can talk about that right now. I've got include, exclude. So basically you're going to run a report for fiscal 19 that has we call it an all funds, all revenue report. Pretty much every system has it. Vadar, SoftWrite, Munis, KVS, they all have something similar to this all funds, all revenue report, which is going to give you everything. It's going to give you your transfers, your debt proceeds, everything. And then what you do is you're going to pull out the ones that don't get included, like all your agency funds come out because agency is excluded. It's not a general revenue source of the city or town. Your trust funds, all the interest on your trust funds gets pulled out. Your any proceeds from the sale of investments gets pulled out. Debt proceeds gets pulled out. Transfers between funds, you pull those out. Anything you get from the federal government, because they knew there was going to be this big ARPA, CARES type money coming in, they said exclude all the federal government money. Just exclude it. We don't want that skewing any calculations. So all that comes out. Utilities. Utilities come out. Actually, I've got utility SOAR is excluded. That should be water is excluded. SOAR is included. I apologize for that. Just saw that error. That should be water that's excluded. SOAR is included. So that's basically, it's everything to answer that question. And when we get to the example, you'll see it. So anything else in there, Chad?
There was, somebody was asking if you knew of any way to obtain approval for the Cannabis Impact so it does not exclude our community from utilizing this method, as it does not seem to align with the spirit of the overall objective.
Yeah, the only thing I would recommend you do in that situation is to email the Treasury. I think in some of the DLS correspondence, they have contact information. But that would be the only thing I could advise is to, if you look at the 3 things in front of us, the interim final rule, the Q&A, and the census, I would say you have to include the cannabis based on looking at those items. If you could get a specific exemption from the Treasury, that would be great. And I think it would be worth the effort because it does spoil the calculation. And so does the debt exclusions. It spoils the calculation. Okay.
Yeah, you move on.
Okay, so this is right out of census. I'm sure you've seen this. Anything pink is excludable. Anything green is includable. I don't know why, and I can't get an answer to this, but why liquor store revenue is at the top of this this list blows my mind. And it's not just part of, you know, the regular, I guess they expected liquor store revenues to be very high. But it's funny how you've got some major categories up there and then you got liquor store revenue. But anything in green, like I said, is includable. So if you look way to the left on the screen, you'll see that from the federal government is excludable. You'll see that unemployment compensation. If you come over to the way over under social insurance, public employee retirement system. So that would be your MTRS that the state pays on behalf. Those things they all thought about and decided to exclude those, which was the right thing to do. Obviously, there are things that they may have overlooked that we may get some better clarification on from the Treasury. So this is a pretty good, I kind of look at this as a cheat sheet when I'm doing things. So calculation uses, we've talked about this, base year 19, which is the last fiscal year before the pandemic began. Counterfactual revenue is what your revenue should have been based on your fiscal 19. And then this you do for 3 years. So you're gonna do this for 3 more years. So you can do it for 20. You can keep doing it for 21, 22, 23, and that's when it ends. So you can keep doing it. If you don't get a great answer the first year, you might get a better answer the second year, and vice versa. The growth rate, like we talked about, is 4.1. Calendar year 20 is 18 months from the end of 19. So you're allowed to use this higher rate of, it comes out when you do your compounding, it comes out to 6.2126 is the exact number. And the final 3 years are at 4.1%. So the 6.21 is going to go away. And in the last 3 years, you're at 4.1%. Growth rate may be adjusted. This was a question I answered earlier. If the actual growth rate is greater, the actual growth rate you do from 16 to 19, and it would require you to look at 4 fiscal years. So it's a little bit more work, but it's doable and it's worth it. If you don't get a great answer for your first year, like I did a client today, and they got a lot of money. And I said, you had some growth. You might be able to get more if you went back, but do you have enough? You know, do you need to go back? And they were fine with the first year because they'd never even used the whole thing in revenue replacement anyway. So they got a good answer. But if you get a very low amount or a negative amount, it's worthwhile to go back and look at the 4 fiscal years to see what your actual growth rate is. Okay, poll question 3. Have you already calculated your revenue replacement and got to a flexible amount? Have you calculated it and not got to a flexible amount, or have you not calculated it? That would be the next.
Yep, working on it. Okay, 1 second. Go.
So this is the real good one before we get into the, and we'll have another poll question immediately following this. So we'll wait a second. Do you have any questions in the chat, Chad, while we're waiting?
No, actually, you kind of caught up, I believe.
Okay, good. Good. There was a lot of questions asked that we did answer, you know, so we were able to go through those slides pretty quickly.
Or 20 seconds or so, and we'll close this one down.
Actually, Tony, while Parker's pulling that up, someone asked, is there a place we can send a revenue loss calculation to verify it is correct?
You got to go to your auditors. I'm getting inundated with these, so it's just part of the process. And I think you should have, your auditors are going to be telling you if it's right or wrong 12 months from now when they do the audit. So you might as well send it to them now and make sure they agree. You don't want to do it incorrectly and have the auditor say, you booted it by $2 million. Now you got a major problem, especially if you use it in your tax recap or something. So So I would suggest you reach out to your auditors and ask them to look at it. There's consultants out there doing it. We're doing it. We're doing quite a few of these for clients that don't know how to do it or can't do it or don't have the time to do it. So reach out to your audit firms. There's everyone should be getting up to speed on this and should be knowing how to do it. All right. So
one more question, Tony, actually. For actual growth calc, those are fiscal years 16 through 19 is the question.
Yes. So fiscal 17 to 18 would be 1. 17 to 18 would be 2, and 18 to 19 would be 3. So those are your 3, and then you divide that by 3.
So it's not fiscal 16 then.
Well, you'd need 16 to get your growth to 17.
Okay.
So you'd have to figure out 16. That'll give you what your growth rate is in 17. 17 gets you 18. 18 gets you 19. So you need 4. You need to line up 4 of them. Okay, so the question about flexible funds, who's done it, who has not done it? It looks like out of the ones that have done it, which is about how my clients are tracking, I said about 70% are qualifying. So out of the 28 in the room that have done it, about 23 qualified. So yeah, so it's right around the 70% that we're getting in our client base. It looks like 30% who tried did not get a favorable answer. And over half, this is important, over half have not even tried it. So that's important. So you have to do this. In my opinion, you just got to do it. So let's find out why. Maybe you don't have to. So let's go to the next slide is another poll question. And all right, so why haven't we done ARPA revenue replacement calculations? Is it because they're earmarked 100%? So maybe, and this is just for the 33 who haven't done it. Is it because they're earmarked? Is it because you thought your revenues exceeded forecast, or is it just too complicated and cumbersome to understand?
Be shocked, Tony. Cumbersome is in the lead. And it's not even close.
Okay.
So, and this, I think we've got. So.
Okay, so of the 33 that have not done it, well over half are saying they don't understand it or it's too complicated. That's a problem. That's why we're here. We need to get people to understand this, because that is a problem. There's an opportunity here to have funds that are flexible, and half of those that haven't done it, it's just simply because they don't understand. So this is great. This is a great educational tool, and it's great bringing an understanding. It looks like about 7 have it earmarked, and 8 just saw revenues exceeding forecasts and haven't bothered to do it. So they said most likely don't. So we've got a bunch that might have some work to do. So hopefully this has been very helpful. It seems like it has. And the common misconceptions are: we beat our revenue forecast, so we don't qualify. Our revenue was greater than last year, so we don't qualify. And eligible expenditures are still restrictive, so why bother going through the calculation? So some folks said, well, it's so restrictive. They don't realize that it's a flexible bucket. It's a flexible bucket because had you had the revenue, you could have used it for whatever you wanted, basically. So it's replacing that. And here's a very simple calculation before we get into the complicated one. So this is a community with revenues in fiscal 19 of $67,500,000. They had 50 million in property taxes. They grew those property taxes at 3.5%. They did a 2.5%, prop 2.5, plus they got 1% for new growth. it got them to 51,750. Intergovernmental didn't grow because the state level funded the cherry sheet, so it didn't grow. Local receipts, I'm observing that those are pretty much flat. You've lost it in areas like meals and some permit activity, maybe hotels, but it's getting made up in other areas. But I'm seeing that they're basically flat because of the pandemic. And then special revenue is typically consistent from year to year. So in this particular situation, we take the top and we've calculated what the probable revenue would be. So when we get to 12/31, I'm estimating that the revenue is probably going to be around 69,250,000. The bottom shows you what the feds are allowing. So the feds are applying this 6.21% in the first year only, and they're coming up with 71,690,000. Okay, so if your revenues are what I think they will be, which is the 69,250,000, in this situation, this $67 million community has about 2.4 million of revenue loss that they can use. And like I said, this is a very simple calculation. I'm going to go through a whole, on a different spreadsheet, I'm going to go through how to do this in a complicated situation. Any questions on this simple calculation?
Tony, one question is, if we had the revenues, we could have used it for whatever we wanted, except our spending is set at town meeting. The federal money is mostly unrestricted. We don't need town meeting approval to spend it. Question.
No, you do not need town meeting to approve this. For transparency's sakes, I'm saying go to the Board of Selectmen, vet it with the finance committees and the audit committees, make sure there's a bunch of people involved in the decision-making of how to spend this, but you do not have to go to town meeting. It's not subject to appropriation.
And the next question was, what happens to the number today when we recalculate in future years, especially if it is lower in future years?
If it's lower in future years, you simply wouldn't have the you wouldn't have the amount. You wouldn't have the ability to spend in future years. If it came lower in future, if your revenue,
yeah, saying especially if it's lower in future years.
If it continues to go lower, you're going to continue to accrue revenue replacement. You won't be capped at year one. You will continue to accrue it as you go through each year if your revenue is not growing at that 4.1%. And you're always using base year 19 as your base. So by the time you get to next year, 21, it's going to be the 6.2 plus the 4.1. And the year after, it's going to be the 6.2 plus 8.2. It compounds every single year. So for those that are not getting it this year, you may get it in the future.
Hey, Tony, one other question came up. Is there a deadline to complete the first calculation?
Yeah, I believe it's in January sometime. I don't know the exact date. It was supposed to be before the end of October, but they extended it, and they extended it out to January. If you're going to use it in your tax recaps, obviously you got to be getting it done pretty soon. Okay. So under the simple calculation, there's a great calculator out there. The GFOA puts it out, and it's got about 4 tabs to it, which I'll show you when we do the example. This is the front sheet, but basically it's showing you your base year revenue. All the calculations are in here for you. The things I was talking about, the 4.1 and the 6.2 and all that, you don't have to worry about that. It's already in the if you're using the GFOA calculator, it's already built in. So you just put the numbers in, which is great because who wants to do calculus on this thing? And I was just kind of giving you the nuts and bolts and the engineering behind how they get to the numbers. So in our situation, when we put the base year and the counterfactual revenue in, we end up with that automatically. It pops out that 2.4 million down the bottom in revenue replacement. And the causes for failing a loss, we've talked about this, and what I've seen is your large debt exclusion. if you had an enormous amount of state grant activity in 20, and let's leave MSB out of it for a second, but say you're a community that does Chapter 90 off one year, on the next, and 19 was an off year, but 20 was an on year, okay, you're not gonna be able, it's gonna impact your revenue replacement in an adverse way because your grant activity is higher in 20 than 19. Vice versa, if you had a big project for Chapter 90 in 2019, and you don't get that revenue in 20, that's going to help your calculation. The next one is the marijuana stream, which we've spent a couple of minutes on today, but that's another one where I'm seeing it's causing a disqualification to the calculation. And then any other significant new revenue. I had one client, beachside community, for whatever reason, their parking revenue skyrocketed. A lot of people, I guess, escaped to the beach, and it was just skyrocketing. Rather than traveling abroad or going wherever, their parking revenue went off the charts. So that was big new revenue type of thing. And the uses is for any lawful municipal purposes, except those specifically excluded below, which is debt service, pension, legal settlements, and stabilization and fund transfers, reserve fund transfers. That's those are your uses and exclusions of your uses. Okay, the application. Okay, how does it go into your balance sheet? You can carve that piece out as its own bucket, kind of like when you pulled FEMA out for CARES. You can carve this piece out as its own bucket, and you can charge directly to that. So you keep it in special revenue. You could transfer it to the general fund and have it in a reserved, some sort of reserved account in the general fund. You could do a direct transfer and include it as included as an estimated receipt on your tax recap. So one thing we've talked about is motor vehicle being soft this year because of the chip shortage. So you're seeing a lot of vehicles being sold, but they're basically used vehicles just changing hands. And that's not creating any extra excise tax. So motor vehicle could be soft. So this might be an opportunity to get conservative in other revenues that might be soft, where you might be aggressive with some years on your tax recap. Be conservative with those, and you can actually put the revenue replacement as an estimated receipt right in your tax recap. The DLS is allowing this. There's no further appropriation required for those actions. And it makes sense, someone brought this up, it makes sense to check the calculation with your auditor before it's formalized. So I got one last poll question, then I want to get into a quick, we might go over by about 5 minutes, but I want to get into a quick calculation. But you want to keep going, Parker?
I'm getting there in a second with the polling.
Yep.
Second. One. Right poll.
Tony, while that's coming up, Jim Johnson asked, does the same apply for new growth?
Yes, new growth would increase your taxes the next year. So if you had significant new growth, yeah, that would negatively impact the calculation.
Heads up for everyone, I did put that GFOA calculator in the chat. So if you want it, Tony mentioned, it's in the chat, you can just download it.
So before I go into this big complicated example, I would love to see who will be jumping in and rolling their sleeves up and doing the calculation.
Tony, Eric Kinshirf had a question. If you can use ARPA funds for most of the expenses, this would free up money to appropriate for debt, OPEB, etc. from non-ARPA funds. This meets the letter of the law, but not the spirit, ?
Yeah, no, you can, and I figured Eric would ask that question, so I shouldn't answer Eric's questions, but yeah, you can play the, there's a way to play the shell game. If you're putting it in as to balance your budget, you are indirectly paying for those expenses. Absolutely. The requirement right now, which could change, is that you have to identify. So if you put it into your estimated receipts, you have to identify which expenses you're paying for. So you could, so say you got $2 million and you're in a small town, you could say, well, I'm paying for the entire police budget, or I'm paying for, it could be a capital, your cash capital. So, or your pay-go capital, it could be road work, it could be purchasing equipment for the DPW, or like I said, it could be just paying for the budget of an entire department. And that's, oh, great. So we will calculate the replacement after today, overwhelmingly positive. So that's great to hear. So let's get into the next. I'm going to exit out of this, and I don't think I have any more slides left on this. No, I'm going to exit out, and I'm going to pull up. Every time those poll questions come up, Parker, they screw with the presentation.
Lock you
All right.
up. Sorry about that.
All right, so here is, this is great, okay? I stole a part of this, if Mary Sahadi's out there, I stole part of this from Mary Sahadi in Fall River. I like the way that they designed their revenue replacement calculation. So I said, hey, that's a great way to do it. I made a couple of changes to it, but I really like the way it was done. And I'll walk you through the whole thing. If everyone can hang on, I know we're at 2:30, but if everyone can hang on for a few minutes and ask questions, this will be great. Parker, we have time, right?
Yeah, we have time, Tony. We told you it was an hour 15, and we obviously have as much time as we need.
Okay, super. So
People have to drop, they can drop, and we'll get them.
feel free to ask questions. This is a real example right here. This is the town of Hull. Mike Buckley agreed to allow us to use this. He's already gone through this process a couple of weeks ago. So basically, you're going to need a data dump, okay, of your, oops, take the numbers locks off. You need a data dump, and fiscal 19 is easy because most systems are designed, or all systems are designed to end in fiscal year 19. So you do a data dump called, what I'm telling clients is all funds, all revenue report. And it gives you everything. If you come down all the way down, it gives you your real estate, your motor vehicle, your all your state, all your interest, all your licenses and permits. It's a pretty long report with many rows. And there's all your grants. It gets into your insurance proceeds, sales of lots and graves. I mean, it's got everything: donations, gifts, boat excise, sewer charges, water charges, transfers, other financing sources. This was actually had an electric company, so there's electric liens and so on and so forth. So this one was 354 rows. And so Mike basically ran a report, dumped it into Excel, and it got populated into fiscal year 19 column. Calendar year 20 is a problem, okay? That's probably the hardest part of this, is getting calendar year 20 numbers. Munis has what's called a flexibility report, but you got to really look at the data, because it might give you some funny numbers on real estate. So you got to really look at it. If you're doing a lot of period 13 adjustments, it's kind of, skewing things a little bit. So what we're finding is in Munis, we're using the flexibility report. In Vadar and some of the other systems, we're taking a 1/1/20 to 6/30/20, a 7/1/20 to 12/31/20, and then we're looking at period 13 to make sure there's no funny stuff going on in period 13, the period right after the audit. And then you kind of have to splice it together. You have to put half of it on a spreadsheet and combine the 2 years. Had to do this yesterday for one of the clients. In one system, the client actually did all 12 months. They just ran a report for each month, and they did a massive spreadsheet. But that is the hardest number to get to. So be prepared to know how to do that. Some of them have called their software vendor to see if they can design a report. But once you have that in Excel, you dump that. You dump that in this next column. And calendar year 20 is going to go in this in the second tab on this spreadsheet, or the third tab. But I put it next to 19 so I can compare. You know, I can compare what's happening. Did I get one big grant one year? Like, for example, let's take a quick look here, something big. Like government aid, you can see government aid was 400,000 larger. And here we're looking at row 59. That's going to affect the calculation in a negative manner. So you basically look through these changes and you can kind of tell where you're going to end up by doing that. And for this particular client, I believe there was a big settlement. I can find that. It's like $1 million settlement that they got in 19, and obviously they didn't get it in 20 because it was a one-time settlement, but you're allowed to use it as revenue replacement. And again, is that the spirit of the rule? Probably not. The towns having the cannabis are getting punished. The town getting the legal settlement in 19, which has nothing to do with revenue, it's just timing. The lawyers had it in their escrow account, got it to the town, you know, potentially got it to the town later. They're enjoying the benefit of that. So there is some loopholes in here that do benefit and not benefit clients or communities. So once I got this laid out, I put it into buckets, and you can see across the top, property, motor vehicle. And I do it in this manner because this is how it's going to go into the GFOA calculator. So I do all the columns, and then I just put, and this is this right here is calendar 19, the fiscal 19 rather, the tab we're on. So you'll see the 15 is in the 15, the 57 is the 57. So they all kind of, I figure out what buckets they go into. The column that, if you go down here for transfers in, you'll see that a lot of things, that's going to be excluded in the end. So we got this transfer in column. And as we go down, we'll see a bunch of numbers that get, you see the big numbers, 1.4 million gets excluded because you're not allowed to include that. You come over here, you've got intergovernmental revenue passed through the state. That's the federal revenue. In this situation, they had 1.3 that we have to exclude. There was direct federal revenue, 7,900 that we had to exclude. State revenue is all included, 8.3 million. So basically you follow this format. It's a pretty easy format. The way it's laid out, I like it. It puts it into buckets. It helps you identify, like when you have a big number that you don't understand, this helps you identify why you have a big number. You do the same thing for 20. Same thing goes across. You be consistent. You do the same thing going across. And then I have this filtering all the way up through this. This all filters into this lead sheet. So we have 2019 base year and calendar year. So this particular community had a $3.6 million revenue loss. Boy, were they happy that they went through this. They did not think they had any money to spend. They thought they had to do all wastewater, and they do have wastewater to do, and it could go through this. You know, this just allows them this flexibility, but they could still spend all their wastewater on, even if it's a revenue loss, it doesn't matter. So as we go through it, you can see that your real estate taxes bumped up. Your motor vehicle was pretty flat with the prior year. Your sales tax kind of flat. Your other charges, intergovernmental state went down a little bit. These are all excluded. Your SOAR, which you're allowed to include, SOAR you're allowed to include, water you're not allowed to include. So the SOAR revenue took a hit. It's $1 million less, almost $700,000 left. That helped the calculation. Other miscellaneous, big difference. $1 million difference in other miscellaneous. I believe there was a legal settlement or something fairly large in there that allowed this client to use as a benefit. Proceeds of debt comes out. And then most of this, other than those two large items, most of this is driven off the growth rate. They just didn't grow at the growth rate allowed by the federal government. So then down here, I put what row it's going to appear on in the GFOA calculator. And we go into the GFOA calculator. And you put all your revenues, you transpose them into here. And I love this because it's nice. It's a nice little documentation worksheet that you can use. So you plug all your base year based on the cross-reference from that worksheet that I did. You do your actuals, same thing. This is your calendar year. And then it does the math for you. Everything populates up. And lo and behold, they got revenue replacement of 3.6 million. So they ended up with a 6.4% of their revenues, 6.4% in revenue replacement, which is a significant amount. I'm seeing about 4 to 5% as the number. In an extreme situation, I've seen 10. They had a lot of state activity that wasn't consistent year to year. And then the rest are losses, but mostly I'm seeing, like I said, 3 to 5%. I did see one very large one. Growth rate, if you did that, so say you weren't happy with the 19 versus 20, what you would do is you could come in and actually do the same, put in the same tabs and do it for the 4 years, and you plug them all in here, 16, 17, 18, 19, and it does it automatically for you. In this situation, it's not applicable because the town was happy just with the 3.6 million. They didn't really need any more funds. So that is the more complicated calculation. Are there any questions on that?
Yeah, we actually have a bunch of questions.
Okay.
The first thing, a couple of times people asked, is this Excel sheet something we can share after the meeting with people?
I would happily provide it to anyone that emails me.
Okay.
Tony, another question came up from David at Acton Boxborough. Is there anything about could the revenues for the regional school district be used by member towns in their revenue replacement calculation?
From what I understand, and so I in the slide I included the 2017 government of census. In there, it tells you, so that the key is, if you look at the question and answer, it says, are you dependent or are you independent? And you have to meet 4 tests. So yeah, we all know a regional school district is dependent on the towns. It is, but for whatever reason, it doesn't meet those 4 tests. So you kick it out to this 2017 publication, and in there, you go to Massachusetts, and it actually says regional school districts are independent. They've already reached that conclusion. So to answer your question, directly, can you participate in calculating the revenue replacement? My answer to that is no, I don't think so, unless someone emails the Treasury and they come up with a different answer. And I did run this by Copeland and Page also, the law firm that advises the town that's part of this regional school district. And they basically said it makes sense. What we came up with made sense. However, if you have replacement loss, you can allocate a piece of that to your regional school district if you want. You just have to have an additional assessment, call it a capital assessment or something else. So you can still share this with the regional school district. You just have to put it into your budget, basically. So you would, or you could charge it directly to the special revenue account. So hopefully that answers Dave's question.
Okay. Are state grants other than Chapter 90 and local grants included? I just want to follow up on that one.
Yeah,
Again.
Chapter 90 and local grants are all included, all of them. The only ones that are not included are if they pass through from the federal government, like your Title I or your SPED, your SAFER grants. Any of those CDBG, any of those that pass through the state, but they're really federal grants, you have to exclude those.
Tony, another one here from James over at Norton. If the FY22 tax recap is already done, can they increase the FY22 budget using revenue replacement and transfer the ARPA funds to general fund without ever being reflected in the tax cap or without town meeting approval?
So if it's already been done, you can do a transfer. If it's already been done, I would believe you could do a transfer to the general fund. And it would basically be an add-on to your budget, you know, one of those subsequent to the tax rate type of things.
Someone wrote in, Tony, I have heard that there's been legislation filed to define infrastructure, bucket 4, to include roads and buildings. Have you heard this, that this is a discussion and possibly down the road?
I haven't. That would be great for those communities that can't get the revenue replacement. That would be a tremendous amount of relief for those communities. I haven't heard that. I heard some rumblings. I didn't realize that there was actually a force behind it. And I haven't heard any updates on that. So that would be interesting to follow up on. I don't know if anyone from DLS who's in the room can hit the chat and do an update on that or not, but I haven't heard of that.
And following up on that, I just want to point out to everybody, Deb Wagner from DLS, a little farther up the chat now at this point, she posted their guidance as a link.
Okay, and that's a great tool to go look at, the DLS guidance on all of this. And just to be clear, the DLS is not really getting involved in the expenditures and what's allowable and disallowable. They've clearly said it's not, and A&F the same, it's not their ball game. This is basically the town making a determination and then dealing with the audit firm. The audit firm comes in and determines is it eligible or ineligible. And then it's just like a regular single audit at that point. It's unlike CARES where you have to get approval first.
And I think following up on the previous question, someone had earlier on asked if we'd heard anything about whether the Treasury would be issuing an updated FAQ.
I assume it's coming. I don't know when, because there's been at least 15 or 20 very important things that we're all kind of struggling with in the CPA community, at the towns. So I'm hoping that there's another FAQ. The FAQ was laid out. There was a deadline, you know, the whole thing was out there. I think they expected everyone to know exactly what ARPA was by June, and nobody really was ready to ask a lot of those questions. Now that we're actually getting into the calculations and the meat of the ARPA, everyone's trying to finish CARES in May and June. They weren't really thinking about ARPA. A bunch of new questions and answers have surfaced, like the ones that are coming up in this room, that some of them I don't have the answer to. And I know I've talked to Renee over at Powers and Sullivan, who spent a lot of time on this as well, and Deb over at the Department of Revenue. And there's a lot of things that we just don't know right now where those things stand.
Yeah, I would throw in that I think with it being a 4 or 5 year grant, as the single audits start getting issued, there's going to probably be questions about whether or not there's findings and stuff like that, or the Fed will start seeing how the money's being spent. And I would expect that they would step in and clarify those things if they start seeing things they don't like, but they haven't said that they will.
Yeah, and we have
Wagner
monthly
wrote
meetings.
in too, Tony, to respond. You can close the revenue loss directly to the general fund. The accounting guidance covers this. There would be no reflection on the recap. We will need to know this for the free cash certification for FY22. There will be a balance sheet checklist question.
Who's this? Was that a Deb
That
Wagner?
was Deb Wagner from DLS.
Okay. So could you read that again?
Yeah. let's see, you can close the revenue loss directly to the general fund. The accounting guidance covers this. There would be no reflection on the recap. We will need to know this for the free cash certification for FY 22. There will be a balance sheet checklist question on this.
Okay, so basically saying that whatever's left in that fund can be closed and become free cash. That's basically, I believe, what Deb Wagner is saying. Correct me if I'm wrong, Deb.
Let's see here. Is the revenue replacement separate from the monies we already received in July?
No, it's part of that.
Tony, just to clarify, I'm talking about the revenue loss calculation. If you do the revenue loss calculation, you can just close it to the general fund and just document what you intend, to cover. It's basically what we've been calling like the book report
Okay,
documentation requirement. So you can just close it. But again, because it becomes free cash, when we try to prove free cash, we'll need to know how much you simply closed without including an appropriation for it to your free cash calculation, for your free cash. So we're going to be
Right.
including a balance sheet checklist question where you can indicate that for next year.
okay, no, thanks for clarifying that.
Okay.
Yeah, and we will need to know in narrative, right now it's in narrative form, what those funds were used for on the audit side. So so there's a couple of little quirks to that for the end of next year. Thanks, Deb.
There was a question, Tony. Do you need to use the GFOA worksheet, or will the Excel file suffice?
Oh, the Excel
Both
file
the
is
same
fine. I think the
specific
GFOA worksheet is a nice little, it's put together well. The calculations are perfect. There's no formula errors or any of that sort of stuff. So I like to use that. And when we do the documentation, but you can do it on the back of a napkin as long as it's understandable. I'd rather not see it on the back of a napkin, but an Excel spreadsheet is fine. Like the one we have here. I do a combination of both. So whatever suits your fancy, as long as we can get, as auditors, we can get to the number.
And then there was also a question, once the revenue loss calculation is completed, are the replacement funds in addition to the funds the community has received in FY 22, which is, I think, a different way of asking the question similarly, but just to address it.
Well, what was that again, Chad?
Right. Once the lost revenue calculation is completed, are the replacement funds in addition to the funds the community has received in FY 22?
No, it's part of the whole pocket of funds. It's a carve out, if you will. So you're going to have, you've already received half of your funds. You'll receive the other half in May or June, I think. The revenue replacement is the carve out of that whole part, of that whole piece.
And someone just wrote in, if the revenue loss is closed out to the general fund into free cash, does that mean we don't have to increase the expenditure budget, in essence having a surplus budget for FY 22? I don't know if Deb wants to chime in on that one.
That's more of a DOR type of question. Yeah, Deb's on mute. Oh, there she is.
Oh, there she is.
Hi, so I think we said that because you can use the revenue loss component for almost any general fund purpose, that if you close it out to just the general fund and you don't increase your expenditures, you effectively are just offsetting your expenditures in the undesignated fund balance account. And so
Right,
you
that's
can
basically how the mechanism.
You can just, yeah.
That's what it indirectly, that's what it accomplishes, and it ends up
Exactly.
increasing your free cash.
Right.
I like that.
But again, there's a documentation requirement. You just have to, I think, generally say what you intend to have those funds cover.
That's it for questions, Tony, that I have.
Okay. Well, that was great. Thank you for doing this, Parker. And I think it was well worth it to the individuals that attended.
Well, thank you all for attending. I know we had a big crowd today and hopefully got most of your questions answered. If you have additional questions, obviously you can reach out to Tony or myself or Chad or anybody here. We'll do whatever we can to get you answers. And obviously we'll send out recordings to all the registrants. Make sure you guys get a recording of it. And as I mentioned before, if you think of things that you go, hey, this would be something that'd be useful. Again, if it's something either on the pension and OPEB side, we're happy to present it. Audit side, we got folks like Chad and all the other firms and Tony and all the other firms we work with can do something there. We've got the investment people we work with, or just any other thing you think would be helpful. Just let us know. And we'll gladly bring the professionals to the table. So, just certainly let us know. We'll do whatever we can to get you information. So again, thank you everyone for the time.
We're having monthly updates with the CPA group. We have Mass Society of CPAs has a Zoom meeting every month, and we get the latest and greatest. Deb's usually involved in those meetings as well, so she'll give us the latest and greatest from the DLS. We'll have, if we're getting any further guidance on MSBA or marijuana or debt exclusion, those things that came up a lot today. If we're getting any sort of those sorts of questions answered, we'll try to get these out to you as quickly as possible.
Okay, thank you again for everybody. And again, we'll get you out the recording in a day or so. My people on the back end do all the hard work, which I'm really not doing, and then we'll get that out to you guys. All right, thanks everyone.
Thank you.
All right, bye guys.